Hey friends, welcome to the Singapore Market Digest for Wednesday, May 14, 25. I'm Iggy from the Investing Iguana, and today we're diving into what's been happening on the SGX. The overall market has been showing mixed signals today as investors digest a series of corporate announcements and quarterly results. Let's jump right into the key company developments that might affect your investment decisions. First up, City Developments Limited, or CDL. This major Singapore property player announced yesterday that they'll be repurchasing 10% of their preference shares at 78 per share. That's about 26.8 million shares in total. CDL is doing this through what they call an off-market equal access scheme, which means each preference shareholder can sell up to 10% of their holdings as of June 2nd. If some shareholders don't take up their full entitlement, others can actually sell more than their 10% allocation. What's interesting is that the repurchase price of $0.78 represents quite a discount to the last traded price of the preference shares, which was $9.95. CDL noted that trading volume for these preference shares has been quite low, with an average daily trading volume of just 0.042% of the total issued preference shares for the year up to May 9th. However, demand from shareholders who want to sell through this scheme appears strong, based on last year's exercise that attracted acceptances 4 times the maximum buyback amount. CDL's ordinary shares closed at $4.09 yesterday, down 0.8% or $0.04. Moving on to BRC Asia, the steel solutions provider released their first half results yesterday, and they're looking pretty solid despite some headwinds in the industry. BRC Asia reported a 9% year-on-year increase in net profit, reaching $42.1 million, up from $38.5 million in the same period last year. What's particularly noteworthy is that they achieved this profit growth despite a 6% drop in revenue, which came in at $715.6 million compared to the $758.3 million previously. The company explained that this revenue decline was mainly due to broad-based softness in steel prices and project bottlenecks in the construction sector, including delays in engineering services. However, their delivery tonnage has remained stable, which suggests that demand for their products is holding steady. On the cost side, BRC Asia's operating expenses decreased by 16% to $23.8 million, helped by lower finance costs and reduced other operating expenses. The company has proposed an interim dividend of $0.06 per share, unchanged from last year, representing a 39% payout ratio and a 1.9% yield. Their shares closed unchanged at $3.11 yesterday. Looking ahead, BRC Asia remains optimistic about Singapore's construction industry, describing it as resilient and stable despite a subdued economic outlook amid rising global geopolitical tensions. According to the Building and Construction Authority, medium-term demand for construction is forecasted to average between $39 billion and $46 billion annually. Next, let's check out Food Empire, a company that many of you might know for their beverage products across various Asian markets. Food Empire released their Q1 business update yesterday, and they've reported a solid 16.3% increase in revenue, bringing their top line to US $136.6 million for the quarter ended March. The company noted that most of their major markets delivered better performance during this period. However, they didn't disclose their net profit figures in this update. Food Empire attributed their improved performance to what they call a dynamic pricing approach. Essentially, they've been adjusting their pricing strategies to deal with inflationary pressures, rising operating costs, and surging coffee bean prices. What's particularly interesting about Food Empire's results is that Southeast Asia has now overtaken Russia as their top revenue market. Southeast Asia generated $40 million in sales, up 33.8% year-on-year. Vietnam stood out, with revenue surging 44.6%, driven by an enhanced sales force, effective marketing, and interactive consumer engagement activities that reinforced brand loyalty. CEO Sudeep Nair called this an inflection point in the group's Asia-centric strategy and expects the group's performance in Asia to be driven by its strong brand positions and supported by the pipeline of capacity expansion projects currently being carried out in the region. South Asia also performed well, with revenue rising 31.7% to US $19.1 million, supported by strong demand for both freeze-dried and spray-dried soluble coffee, with production running at full capacity. Looking forward, Food Empire expects to sustain strong revenue growth backed by brand-building efforts and expansion in Asia's high-growth markets. However, they remain cautious about risks such as high coffee prices, geopolitical tensions, and potential tariff-driven cost increases. Their shares closed up 1.3%, or starting thus, at Swan 53s yesterday before this update was published. We also have news from a couple of Thai companies listed on the SGX. Sri Trang Agro Industry, a rubber group, has posted a significant turnaround in their Q1 results. They reported a net profit of 688.7 million baht. That's about 27 million for the quarter ended March 31st. This is a complete reversal from their net loss of 329.7 million baht in the same quarter last year. Their related company, Sri Trang Gloves, also posted strong results. The Thai glove makers saw their Q1 net profits surge by 189% to 424.2 million baht, up from 146.8 million baht a year ago. Revenue increased by 8.2% to 6.5 billion baht, while sales volume grew 8.9% year-on-year to 9.1 billion pieces. The company says these improved results reflect the continued recovery of the glove industry and the diversified customer base. They plan to focus on increasing the production of specialty gloves and currently produce over 85 types of gloves, including surgical and diamond-textured gloves. Sri Trang Gloves' shares ended flat at $395 yesterday. We've also got updates from a couple of trusts. United Hampshire U.S. REIT reported that their Q1 distributable income was down slightly by 1.4% at $6.3 million. Their net property income declined more significantly, falling 8.4% to $11.7 million, while revenue dipped 2% to $18.1 million. The REIT manager explained that these declines were due to the divestment of some properties, including the freestanding Lowe's and Sam's Club properties within Hudson Valley Plaza last August and the Albany supermarket in January this year. Excluding the effect of these divestments, revenue would have increased by 3.2% year-on-year, and NPI would have been only slightly lower by 1.5%. The REIT's gearing stood at 39.2% as at March 31st, which the manager says provides ample headroom for potentially accretive acquisitions to grow its portfolio. Looking ahead, the manager remains cautious amid the uncertain macro environment, but aims to continue strengthening the REIT's income streams and balance sheet through asset enhancement and development initiatives, accretive acquisitions, and opportunistic divestments. Their units closed 1.1% higher at $445 yesterday. Finally, Asian Pay Television Trust posted a 47.2% drop in Q1 net profit to 7.3 million, down from 13.8 million in the same period last year. Their revenue fell 6.5% to 59.4 million. Despite these declines, they noted that their broadband growth momentum continued during the quarter, with about 8,000 new subscribers added. The trust has reaffirmed its full-year distribution guidance of 00105 per unit for 2025, to be paid half-yearly. They've also entered into new interest rate swaps during the quarter to hedge 100% of their offshore facilities until June 30th, 2025. Their shares closed unchanged at 78 days yesterday. That's the scoop for today. Remember to do your own research before making any investment decisions. This is Iggy from the Investing Iguana, signing off.